Let's look more closely at the current state of real estate and bring in Frank Nothaft. He's executive chief economist at CoreLogic. Frank, good to talk to you. Let's get back to sort of more traditional real estate sector right now and talk about interest rates. Obviously, the affordability equation has improved. Lower mortgage rates seems like it should allow a lot more activity here. Is the market responding, though, in that way?
Oh, absolutely. We've seen a real spur in activity in the real estate markets. We see it in the housing market. We see it in the commercial sector as well. It really helps to have rates down as far as they have come. For example, if we're looking at home mortgages right now, the mortgage rate for a 30-year fixed rate, it's a full percentage point lower than where it was 52 weeks ago.
So I guess it's hard to make this as a firm quantitative assessment, but has activity increased as much as you would expect given that dramatic decline in rates?
Well, we have seen a pickup in home buying activity in the housing sector. So we look at home purchase loan applications. They're up 5% from a year ago. Home sales, whether it's for existing or newly built homes, they're up July to July. And we've seen a real spurt in refinance activity. So there's clearly been a pickup in activity. Now, when we saw mortgage rates much higher, mortgage rates were close to 5% for 30-year fixed rate just toward the end of last year. When that happened, that put a chill in the housing market. Home buyers backed off from buying homes, and we saw time on the market and the inventory of homes for sale really lengthen out. So we saw a big drop in home sales first part of this year. Things are finally beginning to turn around.
You mentioned refinance activity, and you calculate there that about a quarter of all mortgages right now could be in the money in terms of being worthwhile to refinance?
That's right. About a quarter of all mortgages in the country now appear to be in the money to refinance. The median or average interest rate on the mortgages that are outstanding, home mortgages, about 4%. We've got 30-year fixed rate down at 3.5%, 15-year fixed rate down at 3%. So those are very attractive rates. That doesn't mean that all of those borrowers who have higher rate loans can necessarily refinance, because you do need to have good credit and you need to have a sufficient amount of equity in your home in order to refinance. But potentially, that's the number that we're looking at. Yeah, about a quarter.
And have prices, benefited to any measurable degree? It's obviously been a question of affordability as well as supply on some sectors of the housing market for single family.
Oh, there's no question about it. And the drop in mortgage rates has really improved affordability. So, for example, to get a $200,000 loan today compared to a year ago, the monthly principal and interest payment is $100 lower, or about 10% lower than what it was just a year ago, just because of the drop in rates. But what we've seen is home prices, which have been growing at a really good clip, home price growth has slowed dramatically over the last year. So in our national home price index at CoreLogic, we recorded a 3.4% appreciation over the 12 months through June. And some markets began to be kind of stagnant or even showing signs of some weakness in price. So, for example, in San Francisco, prices flat in the last year. In Seattle prices took a dip of about 1 percentage point over the last year. But I do think now, with the pickup in home buying activity spurred by low mortgage rates, we're going to see that turn around, and we'll probably see some quickening in home price growth over the next 12 months.
Frank, would you think somebody would be crazy to take an adjustable rate mortgage at this point? I mean, I thought people 5-6 years ago were crazy to be taking adjustable rate mortgages, but it looks like they were right.
It does look like they were right. They keep adjusting downward. Very attractive rates on adjustable rate mortgages. Still a pretty small segment of the market. They account for about 6% of the number of loans and maybe about 10% in dollar volume, because those borrowers who are taking out higher balance loans often find the rates on an ARM attractive. So you can get a hybrid ARM where the initial interest rate is fixed for maybe 5 years or longer. you can get starting rates on those at below 3% right now, even as low as 2.5%. If you've got good credit and you have sufficient equity in your home. So those are very attractive rates for the right buyer.
But you got to realize you're betting on interest rates not going up.
And actually,
that's right.
Frank, I was going to ask you, as the 10-year Treasury yield goes down, do mortgage rates become less sensitive? In other words, can they track 10-year yields all the way down toward zero, or are there other factors that are going to keep them a bit higher?
There is a correlation. So as 10-year Treasury yields move down, we will see fixed-rate mortgage rates become less expensive as well. Sometimes the spread does widen out over time when 10-year Treasury yields go down really low. We see some widening in that spread, partly recognizing the fact that the 10-year Treasury yields aren't going to stay that low for that long, and there's going to be some uptick in rates, which will affect prepayment speeds on mortgages.
So just going back to housing values, do you see a separation on states where there's high SALT and there's states where there's the ability to actually get your deductions?
Well, we're still seeing that all play out, and there's certainly some high-cost markets where we've seen more of a slowdown in housing activity. I mentioned in San Francisco and in Seattle, we've seen home prices actually either be stagnant or take a bit of a dip over the last year. And in the greater New York metro area, we've seen some sluggishness as well in home sales and home price activity. So that's still playing out. So we'll have to see what the effects are longer term. But some of the strongest markets are markets where they seem to be less affected by the $10,000 cap on the SALT deduction.
All right. Well, makes sense. That's what economics would tell us. Frank, thanks a lot. Appreciate your time this morning.
Hey, thanks for having me.